Good afternoon, everyone. It's Monday, the 3rd of February. Welcome to a new edition of Monday Market Picks. My name is Thilan Wickramasinghe. I'm the head of research for Maybank Securities here in Singapore. And first of all, let me wish you Gong Xi Fa Chai, wishing you a healthy and prosperous year of the snake. Now, the question this week is really, where is the Trump put? How much is the Trump administration willing to let the markets go down? How much are they willing to tolerate? And as they pursue, especially their tariff plans in Mexico, in Canada, as well as in China. So I think safe haven assets and markets will be back in favor. We've seen gold and oil rising. We think that the Singapore banks will actually be another one of these safe haven assets that investors look at. So we will have a look at the fourth quarter preview coming up. Then we are going to turn our attention to DeepSeek. That's been in the news for a long time now, since last week. That's created an upheaval in terms of the AI industry. Hussaini is joining us to talk to us about what this means to the ASEAN data center space. He's also going to be talking to us about what to expect from the ASEAN internet names, especially Sea as well as Grab, going into the fourth quarter. And then we go across the causeway to look at CIMB. Is this still a stock that is a buy? And then we also have our chart guy, Amirul, with two new trading buys. So a lot to cover today. So let's get straight to it as we do. So let me start with the banks. Now, they've actually been holding up a lot better than what we expected, especially today. UOB is actually up a little bit, and all three banks are actually performing better than the STI. So we think that the investors generally are seeing this sector as a safe haven, especially when you have this major uncertainty around the globe, as we are having right now. So what's the outlook for the sector, especially with fourth quarter results beginning to trickle out, with DBS starting next week? DBS is out on the 10th of February, UOB is out on the 19th, and OCBC is out on the 26th. We think there will be two factors that the market will be paying close attention to in terms of judging whether the sector re-rating that we've had will continue to have legs going forward. First is whether earnings momentum can remain positive. And we think that the quarter-on-quarter earnings should be at least flat to positive going into the fourth quarter. On one hand, we have net interest margins, and they would have come off, but not too much. Part of that is strategic, as the banks have actually been shifting some of their excess liquidity to higher quality but low yield assets. And part of that is natural because of the Fed cuts that we've had in the past quarter. On the other hand, banks have actually been hedging ahead of the Fed cut, so that should allow NIMs to be a little bit stronger. And we've also seen credit demand coming back after quite a few months, or actually a couple of years in the doldrums. November system credit actually grew at a 2-year high. And we think that the demand is broadening from not just the large, low-yielding corporates to a much more broader sector, particularly going regional into ASEAN, as well as TMT, as well as some of the sustainability-linked loans as well. So all of this should help hold net interest income higher and actually might come in better than expected. At the same time, we think that trading income will also be pretty strong. All you need to do is take a look at what the US banks are reporting, JP Morgan, Morgan Stanley, all having very blockbuster trading income. And if you look at the last quarter, when you look at FX or when you look at derivatives or rates, we've had the same sort of volatility as we've had in the third quarter. So trading income should actually be quite strong. And as well as fee income as well, particularly credit cards, where seasonally fourth quarter tends to be quite strong. One area where there might be some weakness will be wealth management, which might sequentially be softer as most people go on holiday during fourth quarter. So there's little less transaction activity in wealth management. But we still think on a year-on-year basis, the trajectory should be positive. Now, I said two factors market will be looking at. The second factor will be how strong will be the capital returns. We think from a cost point of view, the banks should actually come in within guidance, or actually might surprise. Asset quality as well, they might come in within guidance, or actually surprise. So there is going to be a little bit more room for managements to maneuver in terms of paying back shareholders in the fourth quarter. CET1 ratios are also at excess levels. So we think that the potential for all three banks to announce special dividends will be quite high, particularly for DBS as well as UOB, given that managements have said that they are looking at this in the past. We also think that there could be a more comprehensive share buyback announcement coming from UOB as well. If they actually do something like what DBS did and buy back around $2 billion or $2.5 billion worth of stock and cancel it, that can actually add about 1.5% to their EPS. Now, the bank that has lagged behind all this is OCBC. They've actually been a little bit more unclear on what they want to do with the excess capital. So if they succumb to some pressure, given the fact that their peers are also coming up with much more generous capital returns, that'll actually be a very positive move for that stock as well. And that actually might have a re-rating on that stock. So overall, going into the fourth quarter results season, we are keeping a very positive outlook on the banks, and we are keeping buys on all three of those names. So do have a look at that, and we do have a note on that in our newsletter today. Now let's turn our attention to AI, and especially DeepSeek. Everyone's talking about DeepSeek. We can't escape it. And that's just been one of a string of bad news that has been coming out for the data center space. We've had the US government announcing their AI diffusion policies that was going to restrict AI chips into Southeast Asia. We also had the Stargate program being announced with Elon Musk and along with SoftBank and as well as OpenAI that can actually encourage data center builds to happen in the US versus anywhere else. And now DeepSeek is saying that they can do AI for a fraction of the cost of the American majors. But Hussaini, our internet analyst, is asking investors to stay calm. So Hussaini, welcome to the show. Why are you so calm in this storm?
Thanks, Tilan. So yes, you are right that ASEAN data centers had been in the path of a tornado in the last 1 month. So a couple of things happening here is first was that AI diffusion framework put up by US government and its target initiatives, and this raised concerns on data center supply in ASEAN. And on the other hand, DeepSeek's R1 and Alibaba's Qwen model shifted focus to overall data center demand, as those LLMs need fewer computing resources, and by that means lower GPUs or data center demand. We think both the outcomes are unlikely to impact current growth trajectory in ASEAN. First, ASEAN is mainly driven by the traditional data center demand for compute and storage, and as such, AI is still away. So to put in number terms, ASEAN's data center infrastructure is almost 50 to 70% below that of evolved markets like US, China, Korea, and Japan, and there is a long runway for growth. And this was affirmed by the expert we hosted last week. Now, on AI diffusion regulation framework, we think restrictions are quite generous. and it's unlikely to impact the announced pipeline. Now to the second point on DeepSeek. So yes, DeepSeek brought in new concerns that not much of compute is required to train LLMs. Compute optimization makes AI more accessible, as well as reduce reliance on high-end GPUs, and as such lowers entry barriers. So what we think is that uh, the DeepSeek would speed up AI adoption, and it will boost data center demand while easing hardware concerns. And on top of that, open source AI adds flexibility such as customization and limited vendor restrictions. So net, we are of the view that DeepSeek is likely to accelerate adoption of AI, and in turn is likely to keep the elevated demand on data center. So a similar point was raised by Michael Goldrich, whom our partner Wedbush hosted last week. So what he noted was that with DeepSeek's breakthroughs, AI moves from niche to mass adoption. He also noted that DeepSeek's availability for free could force companies like Microsoft or OpenAI or Anthropic to reduce their pricing. And this could lead to higher adoption by mid to low tier companies, and as such leads to higher demand for AI or higher AI inferencing demand.
Got it. So I think that's one of the key issues. Like adoption has still been lagging versus the expectations. Now, what are some of the key stock implications from this? I saw Singtel has been quite badly hit today. Any implications, Husseini?
Yeah, means Singtel's today's impact, I don't think it is linked to data center or DeepSeek issues. But in general, what we have seen that in ASEAN and especially in Malaysia, companies like Gamuda, IGM Corp, Sunway Construction has been impacted since the start of the year. And our analyst, Chiu Han, who covers those names, she sees that she reiterated buy on these names. And as such, what we see is that the ASEAN data center demand is unlikely to impacted because of all those factors. And Shiwan, as such, reiterates buying on these names. In Singapore, Singtel obviously is a beneficiary of data center, and that's what we see in Singapore as well, that the data center demand side is unlikely to get impacted. Similarly, JARIC reiterated its buy on CSE Global, which is one of the data center beneficiary in US.
Got it. So some of this pullback actually can be a buying opportunity here. Now, on that same vein, let's turn our attention to the internet sector. Now, this is a sector that's actually done pretty well, particularly with very strong momentum in the third quarter. What are you expecting for fourth quarter, Husseini?
Yeah, sure. So as such, we expect a strong momentum of third quarter to sustain into fourth quarter. We estimate Shopee and Grab GMV growth of 18% and 17% respectively. So a robust growth overall. And this robust growth is underpinned by factors like relatively robust macro and stable competition. And these factors especially favors large operators. On the monetization front, on the margin side, I mean to say, we see a slightly divergent trends. So what we see is that Shopee raising seller take rates, which in turn helps on the margin side, while Grab's services are becoming more affordable relative to its competitors. So in fourth quarter, we expect a slight margin pressure for Grab's mobility and fintech business. And for C, we see slight margin pressure on the gaming side. However, this slight margin pressure are mostly tactical and seasonal in nature, and as such, we don't see a cause of concern.
Got it. So, in terms of the specific stocks, right, when we're looking at C as well as Grab, what should investors be really focusing on for these results?
Yeah, sure. So maybe for C Limited, means we expect a strong 18% GMV growth for Shopee. And on top, we see revenue growth at double that pace of GMV growth. So we expect revenue growth for Shopee at 35%. And this is on the back of those seller take rate increases. And also to note is that company has raised seller take rates in January as well this year. So the momentum should continue into 2025. One other area which I see is a black swan opportunity for C or Garena is the launch of new game called Free City.
Right.
Game right now is in a soft launch state, but it has already garnered a rating of 4.3 on up to down. And this rating is similar to that of Free Fire Max. So we believe that this remains a potential opportunity and creates potential surprises for C going into 2025.
Got it. And about Grab, what do you think?
Yeah, so for Grab, we estimate Grab's on-demand GMV to grow at 17% year on year. And this is an acceleration versus third quarter growth of 15%. And this is particularly helped by faster growth in food delivery business of 16% growth. The same was 12% in third quarter. On the mobility side, we expect the momentum to remain firm at 20% year-on-year growth. What is changing with Grab is that Grab's services are becoming more affordable relative to its competitors. And we think it is a step in right direction, as we earlier flagged that affordability was a key concern for Grab, which we now see that they are addressing, which in turn should help to sustain GMV growth.
Got it. Well, I hope Grab's taxi prices during surge times is to come down. That hasn't seemed to have happened for me yet, but something to watch out for. Okay, thank you, Hussaini. Let's bring in Amirul, our chart guy. He's got some great ideas in this new year. Amirul, welcome to the show. What have you got for us?
Hi, Dylan. Thanks for having me on the show. So, first, let me share my screen because I have several charts. We have several charts to look at. So, how about we look at the STI index first? So, the chart is showing that today it is making a mild decline. But then, if you look at the index, the price movement today, it has rebounded strongly from the 21-day EMA, and it is about to take its previous high from the previous session. So I believe for the STI in general, it's still doing well. The uptrend remains intact given the higher low structure over here. So yeah, it's still in a good time to be in the market. So today I actually want to highlight two different stocks. So the first one will be this one, CIC Global. Like Hussaini mentioned just now, we have a buy call on CIC Global. So why I recommended this chart is because of this one move, which is this one over here. So I recommended this stock when it has actually filled up the gap it has created from 27 December. It has actually once filled up before it went through a mild pullback, but then now it has rebounded again and has tested the current resistance band. And then if you look at the price movement today, it has went through a mild pullback, but then I feel the current uptrend, given the higher low structure over here from this low over here, remain intact. So if I draw a circle around here and I draw another circle, so you could see there's a new high low structure. But then again, the most important thing is if you look at the moving averages over here, the 21-day EMA, which is the light blue line over here, is about to cross above the purple line, which is the 200-day EMA. So this is a sign of improved momentum. And if you look at the RSI, it is also making an upward trend in the RSI. So we believe as long price maintains above this purple line over here, which is the 200 DMA, a stronger rebound would follow suit and might actually test our next resistance at 0.490. And the last chart that I want to look at today will be LHN. So this chart has actually a better setup than CSE Global, mainly for one reason, because it has actually closed at a new all-time high last Friday. So it has actually take out its ascending triangle pattern. So if I draw a line up there and then another line down here, you could see that this green candle over here, it has actually broke above this pattern with a high volume. If you look at the volume over here, it's the highest for the year. But then today it went through a mild pullback, which is expected after a strong buying power last Friday. But then again, I remain bullish on the stock, right? Primarily because one, it closed at an all-time high with very high volume. So that's a sign that a bullish continuation move might follow suit. So probably it's going through a mild pullback and maybe it's going to create a new base somewhere around this line over here, maybe like that, before it actually rebounded stronger and might test our next resistance here at 0.590. So watch out for LHN, because I believe the uptrend from its August 2024 low right over here remain intact. So I think that's all for me today. Dylan, over to you.
Thanks, Amirul. That's great. So just to remind, both LHN and CSE are also Opportunity Plus stocks, which are high conviction fundamental stocks as well. So do look at Amirul's charts in our newsletter today. Now, I want to quickly turn our attention to a Malaysian bank, which is CIMB, and our Malaysian analyst Desmond is calling a buy on it. Now, fourth quarter is likely to going to be soft for them because of weaker net interest margins and non-interest income tapering off after a very strong third quarter. Credit costs, which is the charges that the banks make for bad loans, should be actually quite benign though. So what Desmond thinks is that a lot of the bad news is already in the price. But more importantly, take a look at what he's expecting for 2025. Domestic credit in Malaysia is rising, especially mortgages. Their Thai consumer portfolio has stabilized and margins there should actually recover going into this year. And he also thinks that Indonesia will also recover in their portfolio. Plus, the CEO is set to unveil a new strategic plan that could include a higher ROE target, which will focus growth in Singapore, Indonesia, as well as commercial banking and turning Thailand around as well. So key date to watch out for is the 5th of March, which is when the plan is set to be announced. So we're keeping a buy call on the stock ahead of that. In terms of upcoming events, we've got results season in full swing now. So a lot of the REITs coming out this week: Keppel Infrastructure, Keppel Limited, CICT. We've got SGX coming out as well on the 6th of February. We'll be looking for any guidance on the whole market reform program as well. In terms of events, we've got for those of you who missed our Feng Shui event, we've still got one more with Kenko on the 5th of February. So do sign up for that through your salesperson. With that, unfortunately, we're out of time. Thank you so much for all your support as always, and we'll see you next week. Have a profitable trading week.